Good morning, everyone. Welcome back to the first edition of Your Money Matters for 2021. And today we have some exciting news. Clint Lee's research service, his options-based research service, will be launching this week. So we are kicking off the year strong. We've had a lot of interest. We've had a lot of questions. So there is a link below to make sure that you are first in line to find out about his strategy and his service. Make sure you sign up. Now, let's look forward to 2021, shall we, Clint?
Yes.
Of course, we have no idea what to expect. On one hand, it looks a lot like 2020. Of course, we're only a couple days into it now. There's new variants of the virus that have emerged. Today, as a matter of fact, as we record this on Monday, the markets are down. Political turmoil still exists, obviously. But we are seeing for 2021, which gives us some reason to hope, some pent up demand in the economy that could lead some stocks higher. So let's take a look at that pent up demand, if you don't mind, Clint.
Yeah, I think we'll definitely see a lot of that pent up demand being unleashed as the vaccine gets rolled out. But for right now, at least for the next couple months or so, you're probably looking at the status quo of what we saw last year. So if you're looking for a playbook for 2021, you probably have to go back to last year, at least for these first couple months. That's just because of what you would expect to see in the economy and then how that plays through to certain sectors of the stock market. So what I mean by that is, you talked about this new variant of the coronavirus. In the places where it was detected early on, you're seeing a pretty rapid increase in new cases. It's supposed to be more transmissible. So, that creates a scenario of, these ongoing lockdowns, people choosing to stay at home. And so that hurts the services sector of the economy that's going to help the goods sector of the economy. So here's a chart of how those two areas played out against each other in 2020 through November. So the purple line on here is just all consumer spending combined. And this is indexed to the start of 2020. And you can see we had a slight decline of about 2 or 3% or so. And the moving pieces of that was you had the dip in services. So, people going out and going out to restaurants or staying in hotels or flying, whatever the case may be. We know that dropped off pretty significantly, but that was at least partially offset by the red line on here, and that was spending on goods. As people stayed home, they bought more stuff for their house as outlets for seeking some sort of normalcy or entertainment. But you would expect that to keep benefiting, maybe like online sectors of the economy. People aren't going to go out and spend in a physical retail store. They're going to spend online. But you mentioned this pent up demand, and a lot of that comes from all this excess and personal saving that we've had since the pandemic began. And I've got a chart on that right here. This is the personal savings rate going back about 10 years or so for the US. You see, we had this huge jump in savings up to about a 33% personal savings rate. And even though that's moderated, it's come back down to about 12.9% or so. That's still the highest savings rate in about 45 years. You gotta go back 45 years to find a savings rate that was higher than that. And the result of this is that you have excess savings of around $1.5 trillion that's waiting out there. So that's that pent-up demand. That's that pent-up spending, that spending that people haven't been able to go out and spend on services that as we start to get the vaccine more widely distributed, you will see that money go back into the economy. Now, I know a lot of people are probably wondering, how in the world can you have $1.5 trillion of excess savings out there with everything that's going on with the economy, with the labor market this past year? But I know, Ted, you've got some charts behind the numbers of how this has occurred.
Yes, I do. In fact, hat tip to Nate Silver over at the New York Times, where I got them. In fact, I wrote about this in my Bauman Daily yesterday. So just to recap some of that, the first chart from Nate shows just the dramatic decline, as you mentioned, Clint, in services spending, $575 billion not spent on things, like airline trips and vacations and restaurants and all that. And then, of course, there's also a significant chunk thanks to lower interest rates and also forbearance on things like mortgages and whatnot. So you're looking at a really big chunk of money that was not spent last year. By contrast, that increase in spending on goods wasn't anywhere near as much. It's about 15% of that total. Durable goods went up, non-durable goods went up. That's things like food and booze and all that sort of thing. But just as an aside, that spending on durable goods that we see in that chart, about 60 billion, that's almost precisely the amount of the US trade deficit with China during 2020. So no guessing where a lot of those goods came from. Then there's a second chart that shows where the extra money came from that went into personal savings. And interestingly enough, the wages that people lost last year weren't all that much. And that's because most of the jobs that were lost were very low wage in the service sector. I mean, baristas and waiters and waitresses, waitrons, I guess is what they're called now, went down not by very much, but the government compensated by shoveling a lot of money into the economy, both in terms of unemployment, stimulus, the Paycheck Protection Program, and so on. So a huge chunk of money pumped into the economy that significantly overcompensated for the decline in wages. Now, that's a topic for another day, why there was so much extra, but part of it was just to keep the economy moving. When people talk about, just give money to the unemployed, they're missing the point that you need to stimulate the economy as well in order to keep the multipliers going. Last chart, it goes back to that 1.5 trillion that you mentioned. That's the savings. So that's it right there. That's a huge amount of money pent up. Now, here's the thing about personal savings. It's not just money in the bank. It's also money in brokerage accounts, right? I mean, it's also money that can be spent on stocks and bonds and other things. So we'll leave that aside for the moment, but I think that's an important consideration, that the savings that we're looking at could also, it's available for investment. And that's the thing. I mean, that's the dry powder. And so that is the big question in 2021. Where's it going to go?
Where's it going to go, and how can we make money from it?
Yeah. Well, I'm going to go first, Clint, if you don't mind, because I got a couple of charts that give us some indications. I think the critical thing is that we're already seeing evidence that at least while people are still cutting back on spending on services in particular, and probably already having bought all their computer gear for work at home and all of that, what we're seeing is a piling of investor money into all kinds of assets, but particularly the riskiest. Bitcoin, as everybody knows, had a huge run up. It pulled back yesterday. But towards the end of the year, this chart shows that the Russell 2000, which is basically the small caps, actually significantly outperformed the NASDAQ 100, which is the big tech company. So that means people were looking for riskier bets to try to make extra money as the year wore down. And that tells me that a lot of that money that's out there and available is looking for things to do. They made big gains in March and April. They want more, and so they're looking at the riskier things. Here's the chart that actually shows that run up in Bitcoin. Also special purpose acquisition companies and IPOs. And so my thesis is that there's all this money out there and we already see it going into the riskiest assets. It wants to do something. It's looking for something to do. The question is what it's going to be. Clint, what do you think it's going to be?
Yeah, I mean, I would start looking at the opportunity today to start positioning for that services rebound. You mentioned small caps as being sort of that speculative play, but I think there could also have been some positioning around the vaccine news that the small cap stocks would benefit from a surge and sort of this pent up savings that eventually gets released into the economy. So small caps had a terrific November because of that, as you pointed out. But if you missed out on the surge in small caps and you're worried about where those names are at right now, there's an ETF you can look at. The ticker is PEJ. It's an Invesco, a dynamic leisure and entertainment ETF. More of just a diversified approach that you could take to different service sectors of the economy, things like hotels, restaurants, food services companies held in there. Or if you want to get more specific, you could pull up that ETF and start to go through the individual holdings. But those are some of the names that would benefit if you start to see this pent-up demand, this pent-up savings start to make it back out into the economy, especially once we start to see the vaccine more widely distributed.
Well,
sorry, do you have more to add?
Yeah, I was going to jump in and say, I think in addition to that, I mean, I think clearly pre-positioning yourself for a bounce back in the entertainment and leisure stuff is one thing. But as we've said, there are also opportunities to be had outside the United States. And so I still think emerging markets are tremendously undervalued, particularly the value stocks in emerging markets. So EEM is another, that's the emerging markets ETF. I think that's another one to look at because, remember the dollar weakness is also good for them, for those stocks. So I think, that's another opportunity. I would also look at the REIT sector. I think there's going to be a big rotation away from certain kinds of REITs into other ones. And I think with the low interest rate environment, this is also going to be another good year to keep trying to increase your dividend income because, reinvesting in compounding dividends over time has been shown to beat the stock market, basically. And I think this is a good year if you are in a position to start doing that. If you're young enough, do it now. Things are cheap. That's the good way to start.
All right. Well, I hope everyone listening wrote that down because just for the record, Clint is on a bit of a tear since launching his new service. He's got a 100% win rate right now. Great job, Clint. And again, for more information about his service, there is a link below. Please sign up, check it out, and join us on January 7th. Clint, Ted, thank you very much. I'll see you next week.
Take care.
Happy New Year.
And you.